Good morning from our global headquarters in New York. I'm Menace Crenny. Danny Berger is off. Welcome to Bloomberg Brief. Let's set that agenda. How hawkish a cut can it be? The FOMC meets with consensus building for a 25-bip cut. The game of survival in Japan, Nissan explores a merger with Honda as Honhai enters the fray. And the Biden administration set to launch a trade probe into Chinese chip makers in the coming days. Good morning. Danny Berger has a couple of well-earned days break at the moment. We're looking at equity markets eking out the smallest of gains. This morning up by 1/4%. We're counting down to the third cut of 2024. By the way, the funniest fact of the day, I'm sure surveillance will troll this. The Dow up for the 8th day in a row, down for 8 days in a row before this morning, the longest losing streak since 1978. The consumer is strong. Retail sales were fine. Ed Yardeni says consumer wages and wealth are strong. The bond market is ground zero for us today. Let's roll it over and have a look at the bond market, because you're just off a 4-week intraday high yesterday in the 10-year paper at 440. We're looking for, the risk is a hawkish cut, and the risk is that the dots actually move from indicating 4 cuts next year to 2. That's according to RBC. But we're also keeping an eye on Nvidia this morning, rebounding after going into correction territory and hitting the lowest level since October. Some say Nvidia's pain is Broadcom's gain. Tesla falling as its China factory head Song Gang is set to leave the automaker this week, according to people familiar with the matter. Micron is rising as it's set to report results after the market closes today, which could show a tailwind for AI demand. In just a few moments, we'll catch up with Jane Foley from Rabobank, and later this hour, Citi's Andrew Hollenhorst joins me around the desk. We're going to start the conversation today about the third rate cut potentially from the US Federal Reserve. And in terms of that, you know what? Let me just bring you a little bit of breaking news here coming in across the Bloomberg terminal. This is what we've got for you. US graphite firms seek 920% duty to thwart China on the EV material. So this is a breaking news headline. We're at the beginning of some big evolution in terms of actual tariffs and the threat of tariffs. So this is US graphite firms seeking a 920% duty to thwart the China EV material. I mentioned the dollar. Just have a look at this. This is positioning in the dollar, and I can tell you that the CFTC, the hedge funds, have the largest net long in 7 months going into this particular FOMC. As I say, the consensus is for some kind of a hawkish cut. There's the powerful trajectory of the dollar. It's crushing everything in its path in G10 and in the emerging market space. The Kiwi and the yen under a lot of pressure. Joining me now, it is Jane Foley. Jane, good morning to you. There is doubts about how much further the Fed can cut. How shallow a grave will the rate-cutting cycle be in 2025?
Well, good morning, Manus. Certainly from Rabo's point of view, it could be very shallow in 2025. Indeed, after today's expected 25 basis points cut, we think there may only be scope for one more in 2025, probably in March. Because if we look at the data right now, and we've seen the market really react to this in recent weeks. We've seen that resilience in the US economy. And look at the CPI data last week. Okay, it came out as expected, but there were elements of stickiness in that. And then, of course, going into 2025, you layer on the inflationary impacts of tariffs and maybe of tax cuts as well. So, how far can the Fed go? And we just think not very far. But the interesting thing about that is that the market, coincidentally, as it's been sort of pricing out Fed rate cuts for next year, has been potentially pricing in more for various other central banks. I mean, look at the aggressiveness, for instance, of the Bank of Canada or the RBNZ or the SNB, for instance, and potentially the ECB too. The markets has been pricing in more interest rate cuts from the ECB. And so in a way, for some of these economies, a weaker currency, assuming inflation remains benign for them, a weaker currency could really help their exporters, particularly against the threat of tariffs.
So, I mean, if you just reflect back on the SNB president, we still have ammunition left, and nobody likes negative interest rates. But of course, we know that they have the propensity to work. Give me a landscape of what an FX war 2025 looks like?
Well, I think from the SMB, I mean, inflation in Switzerland's been benign for months, and their Swiss franc has been holding at really quite strong levels versus the euro. So they've got every incentive to try and talk their currency down. Now they know with the Swiss franc there is this additional headwind of potential safe haven flows, which they've been battling with on and off for decades. So there is that too. And I think for the SMB president, his comments last week, and he's made similar ones once before, about possibly using negative interest rates, is again this verbal intervention to try and get the market into this mindset that they could go a lot further. Maybe we shouldn't be buying so much Swiss francs. So it's all about this sort of combat, getting ahead of market thinking.
We're also going to get guidance from Chairman Powell. There's the euro against the dollar. Obviously, we're just talking about the Swiss franc in the last conversation. There we go, 89.37. Language is important because the tone, the language and the intonation from Powell is as effective, perhaps a little bit more effective than the dots some people would say at the moment. If I take my mind back to July to November 2023, the last time we went into a grand pause, the word careful was used a lot more. Nobody's going to directly perhaps use the word skip or hold. Pause has been used recently. How important, or how important is that nuance of that word careful in terms of the guidance?
It is really important, and we've had this from Powell, very recently, that the Fed has got scope to be, I think, cautious. Perhaps it might have been what he said, and so he's already implied that, and I think that's what the market has been pricing in these last few weeks, the anticipation that he will repeat that sort of tone. And of course, the economic data would support that view. There needs to be no particular rush. I mean, back in the summer, it appeared as if the market was, the jobs market in the US was slowing perhaps a bit more rapidly. But since then, it's like, okay, it's slowing, but it still remains relatively resilient. So there is ample scope for the Fed to be cautious. And that's exactly why the market's been pricing out some of the interest rate cuts that it had, penciled in just a couple of months ago.
So 25 basis points, the tone could shift more aggressively to pause. Is that injurious to the dollar? Look at that CFTC positioning that I just showed you at the start of the show. That is not an exhausted long position. And that's the consensus that I've had from Barclays and from a number of other people, that there's still miles in the dollar. There's still mileage in the long.
And I would agree with that. And, we can talk about the Fed, we can talk about the US economy, but we also need to talk about everything else. Yeah. And you look at the position, of tariffs, and you look at the shadow cast over trade from many exporting countries. And you have this view in the market that many emerging markets are not going to see the investment perhaps that they may have done if this step up in tariffs wasn't there. So this real concern perhaps from emerging markets. And then you look at the troubles that Germany is having right now with its production, with its structural difficulties, the headwinds that it's been facing since the energy price crisis. And you think, well, the ECB has been turning its attention towards growth, and inflation in the Eurozone appears to be far better behaved. And so from that point of view, it's like, well, can the euro really rally? Does anyone in Europe want the euro to rally? And so from that perspective, it's not just about the dollar fundamentals, it's about the relative weakness of fundamentals elsewhere as well.
And it's interesting, you've got the real at a record low. You've got more pressure, political pressure on the Canadian dollar, Jane. I mean, this is the dislocation for 2025. It's not just the asset allocation to the United States of America. It's the political dislocation everywhere else. So with that in mind, where does the dollar outperform the most into 2025 on your call?
Well, I think it will be in emerging markets, and and perhaps we, looking at the example of the Brazilian real, but within the G10, there is the possibility that the dollar can outperform all of the other G10 currencies, perhaps with the exception of the Japanese yen. And that is why I think tomorrow's Bank of Japan policy meeting is probably going to be the most interesting one of the week, because the market's expecting steady policy tomorrow from the Bank of Japan. But it needs to be, I think, a hawkish hold from the Bank of Japan, and an indication that they're prepared to go in January, and an indication that they're probably prepared to keep on hiking back up back up to the neutral rate of interest progressively through 2025.
Now, this is where it gets spicy, isn't it? Because the market's pricing, 18-19% of a hike tomorrow. You say that's a little bit of a low tail, but the consensus is that they will remain on hold. What is the risk, the real risk, that you see another flash redux of what you saw on August the 2nd and through August the 5th? The yen rallied by over 6%. That was a shakedown moment in FX. Do you expect more of those in 2025?
Well, I think that was extreme in the summer, partly because positioning was so extreme. The world and its dog were all in the carry trade. They were all short the yen. I don't think positioning is as extreme now. And the other factor is back then the market was still thinking recession for the US. So that was part of that mix as well.
Yes.
So I don't think we're going to have an extreme moves. And a third factor, if you like, is Ueda is much more conscious of perhaps not creating that much volatility. I think there was probably pressure on him from the Ministry of Finance with respect to that move. So I think he wants to communicate a little bit better. So I think we're going to have volatility, but I don't think we're going to have something quite as much as we had in the yen in the summer.
You're stealing my hopes for a VAR shock, Jane. That's not good. I love a bit of vol and a bit of a VAR shock. It gets everybody to sit up and reappraise where their risk tolerance is. Jane, thank you very much. Happy Christmas. Happy holidays to you. Jane Foley there at Rabobank. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. A Defense Department spokesman says that none of the mysterious drones reported over the skies of the Northeast are being flown by the Pentagon, or, for that matter, are part of a secret government test. The White House has assessed that the sightings are not deemed to be of national security or public safety risk. Elliott Investment Management is suffering an exodus of talent after it's becoming more difficult to pitch smaller deals, as it has become one of the largest hedge funds. It also brings into question who might ultimately take the reins of the firm that was built by Paul Singer from just $2 million of assets in 1977. You can grab that story on The Big Take. Great read. And the Biden administration is set to initiate a trade investigation into Chinese semiconductors in the coming days. It bolsters the U.S. chip industry, has been a key focus for Biden, who has taken aggressive steps to limit the advanced U.S. technology from being exported to China. President-elect will be in office by the time this investigation concludes. Coming up on the show, Nissan and Honda are exploring a merger to better compete in the global auto industry. Renault keeps the door open. We discuss the triangulation of the auto industry on Bloomberg.
For Honda's perspective, the biggest benefit is actually the scale. I mean, currently, under the current management, Honda has been chasing some of the collaboration. And the bigger scale, clearly the GM partnership is one of them. They've been working with the Sony recently on Afrila brand. There has been clear change on the company's, the management on focus on the scale and the operation. I guess that's what Honda is expecting to gain from this partnership.
Shows that Nissan surged the most in at least 5 decades, as Bloomberg learned that the automaker has become the latest buyout target in Japan. Nissan's biggest shareholder, Renault, is seeing its shares rise after the news broke. The French automaker is open to the two companies pursuing that merger. Craig Trudell joins us. He leads our auto coverage globally. Craig, we'll deal with the Renault portion at the moment. I mean, they have a substantial holding and legacy with Nissan. But I want to understand just how desperate a moment this is for Nissan, and why perhaps there's such political push to put these two auto beasts together right now.
Yeah, you mentioned, this is the biggest intraday gain for Nissan in decades. That's partly a function of just how far this company has fallen and so quickly. We've seen a dramatic deterioration in this company's business. And I think there was some real concern in Japan about, the sort of long-term viability of this company when Carlos Ghosn left the picture and, things really went sideways for the Renault-Nissan alliance. And I think there was a sort of inclination to try to drive this company into the arms of one of its Japanese partners, and you have a situation where much of the industry has been, consolidated really by Toyota, where they have cross shareholdings with virtually everybody else, and Honda was sort of a natural candidate. I think Honda was really reluctant years ago to sort of entertain that push on the part of Japan's ministry, but I think there is a situation at this point where Nissan is really in such dire straits that perhaps the push on the part of the government has only become more important to really sort of essentially put together a rescue for this company at this point.
So let's just talk about the Renault part of this relationship. They've the 34% holding, haven't they? Nissan, they've got 34%. It's a joined-up adventure with Mitsubishi. They are open to this. Why is this? I mean, post-Carlos Ghosn, this relationship has soured time after time. So Renault happy to perhaps see something stronger come out of this?
Yeah, I think it's a case of, it's fascinating because this alliance, there was, it really was the case for much of it that Renault was the weaker link of the two, right? And I think we've seen this real change just in the last couple of years where Renault has stabilized, but as was the case with Nissan in the past, whereas for Nissan, Renault was kind of a weight around its neck. The tables have really turned, and so you've seen Luca De Meo really sort of gain some traction with turning his company around, at least getting it to a point where it's healthier and better able to compete. There's a lot. A few years ago there was concerns about Renault that are sort of reminiscent of how we were talking about Nissan. Yeah. Now we're not hearing those concerns now, and yet Nissan's woes and the amount of capital that Renault has tied up in Nissan, it's been a weight around their neck now. Yeah,
it's that great moment of perhaps realizing some equity or perhaps reducing their position. Craig, thank you very much. Craig Tudell on the very latest about Nissan and Honda, the deal in the making. From New York, good morning. It's Bloomberg Brief. Time for your front page news. This is what's making headlines around the world. We kick it off with the Washington Post, leading with Luigi Mangione. The suspect in killing the United Healthcare CEO, Brian Thompson, has been indicted. The 26-year-old was charged in New York with 11 counts, including first-degree murder. Prosecutors say the shooting was a premeditated act of terrorism. Up next, Financial Times. Microsoft bought twice as many NVIDIA AI chips as its rivals this year. It's estimated that it purchased 485,000 of NVIDIA's Hopper chips. That put Microsoft way ahead of NVIDIA's next biggest customer, Meta. They bought 224,000. And on Bloomberg, Bank of America, CEO Brian Moynihan says regulators need to reassess and relax the rules around banks. The comments echo executives across Wall Street calling for less regulation and more business-friendly policies. What exactly will that mean? Let's take a listen to what he had to say when he sat down with Bloomberg.
If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted, and a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a bounce, anything. It's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm and discussion, but everything's still out there until the policies get enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. So we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for a 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on them.
Some warnings there from the Bank of America CEO Brian Moynihan on the fiscal situation here in the United States of America. On Fed Day, we'll count you down to the FOMC decision from Bloomberg. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Crenny. Let's set your agenda. How hawkish a cut the FOMC meets with a consensus building for 25 basis points. It's all about the guidance. The game of survival in Japan, Nissan explores a merger with Honda as Honhai enters the fray. And the Biden administration set to launch a trade probe into Chinese chip makers in the coming days. So we're counting down to the Federal Reserve's third cut of 2024. People are concerned about breadth. You've got a nice tick higher on these equity markets. I'll leave it to surveillance to troll me. The reason I put the Dow up there, it's managed to turn things around. Down for the 8th day in a row, the longest losing streak since 1978. Where were you in 1978? There is a lot of concern about breadth, but roll it over to the bond market, ground zero potentially for a little bit of volatile reaction today. You're just off a 4-week running intraday high in the bond market, just over the 440. The risk is the dots. How relevant are they? How material will they help you in the guidance? But there's a consensus out there that the dots may be moved from 4 to 2. Don't forget, bond vigilantes are hunting for somewhere to attack. Bear that in mind. As I say, it is Fed decision day, taking centre stage. And Citi's Andrew Hollenhorst, looking ahead to the rate path for next year, says this. Cooling inflation, slowing job growth, if continued in the upcoming data, would lead to a faster pace of rate cuts than is currently being priced by the market. A popular narrative is that the economy and inflation will reaccelerate due to animal spirits evident in stronger survey data. Andrew joins me now. Andrew, good morning. Good to see you. I wonder, have we and the market just got ourselves in an overly hawked up position? Because the market says 2 cuts next year after today.
Yeah, I think the expectations going into this FOMC meeting are that, yes, there'll be a 25 basis point cut, but maybe the messaging from the Fed is that they might slow their pace of rate cuts, that this might be a time when the Fed gets more worried about upside risk to inflation and less concerned about downside risk to employment. And I think relative to that market narrative, relative to that pricing of, like you're saying, just about 2 rate cuts next year, the Fed can surprise dovishly here. So I'm not saying that they're going to be saying that January is definitely going to be a cut, but they also probably won't be saying that January is definitely a pause. And that's what the market is pricing right now.
How does Powell thread that needle? I mean, if you look at some of the language, I mean, skip and pause and careful. Those are the 3 that I think that we've done a bit of research on. Pause has had elevated word search when we look at the headlines. But careful takes me back to when they last went into pause, which was in 2023. So is that's the kind of narrative you think we get from Powell?
I think that's the language we hear from Powell. That's a really good word to use if you don't actually want to say something, but sound like you're saying something. You want to be careful. You want to be cautious. You want to provide the monetary accommodation or restriction that's appropriate for the economy.
Right.
No one would disagree with any of those things. Of course, you should do all of those things. That could be a 25 basis point cut. That could be a pause in January. They're going to leave those options open.
Look, this is about calibration. The market recalibrates so much more aggressively than the Fed. Look, in the summary of economic projections plus the dots, I just want to get your sense. A lot of people say, oh, they're of no value because they're of limited value because there are many unknown knowns into next year between tariffs and taxes and deportations and immigration. If they dramatically downgrade, how significant a downgrade in the dots are you expecting? Let's start there.
Yeah, so I think the dots right now are showing a median for 4 25 basis point rate cuts in 2025. I think that's going to move to 3 25 basis point rate cuts in 2025. So those dots would migrate higher. Now, to your question about, should we take that literally? No, I wouldn't take it literally, and I don't think markets will take it literally. But remember, markets are already pricing only 2 rate cuts into 2025. So even if they move from 4 to 3, they're still more dovish than the market is. What the market is looking at is what's the direction of travel.
Yeah.
If they're revising those dots up, then that's some signaling that maybe they're going to slow the pace of cuts. But what we also know about this Fed is it's a data point dependent Fed, meaning that each individual monthly data point is mattering for their interest rate policy. Unemployment rate standing just below 4.3%, technically rounds to 4.2% right now. If that moves up to 4.4% in December, and I think it probably will, then they're probably cutting in January. If
we go to 4.4%, we're moving into a very different gear on the economic landscape, perhaps a little bit different to what we presume. To go from 4.2 to 4.4 really is an acceleration, isn't it?
Yeah, so the cycle high that we've been at is 4.3. So I think in that sense, the Fed can say, well, we haven't had this rapid deterioration in the labor market. That's what they've been worried about. And that would really be the move from a low hiring rate to a higher layoff rate. And we haven't seen that yet. So if we saw any evidence of that, they'd be very concerned. 4.2 to 4.4, I think that raises concern, but we haven't kind of completely moved into that deteriorating labor market situation.
When it comes to the debate then about where the neutral rate is, I mean, I've had everybody in here between, the 3 to 3.25, which is where you say, and we'll get there quite quickly relative to other people who sit in the seat and they say, no, we're pretty much at neutral. We're going to get to 4, and that's the real neutral rate. What is the real question we should be asking about neutral rates?
Yeah, I think the real answer is we don't know, and we can't know in real time. So it's a useful theoretical concept when you're thinking about how monetary policy should proceed. You don't really know where that neutral rate is. What Chair Powell has said, and I kind of like this formulation, we'll know it by its works. And what he means by that is we'll watch the data and we'll let the data tell us whether this is an economy that needs more or less restriction. And what we're seeing right now is an unemployment rate that maybe slowly, but is moving higher. If not for a decrease in the participation rate, this is really important. If people hadn't dropped out of the labor force, we'd have an unemployment rate of 4.6% right now. If the unemployment rate was at 4.6%, I don't think there'd be any question about whether the Fed would be cutting not only at this meeting, but again in 100%. January. And that could just come down to a quirk of the data, that participation rate moving, or it could be something fundamental, people actually dropping out of the labor market. So where neutral is, I think the market expectations of that are shifting wildly around based on the data.
For me, the biggest supply side risk is the immigration regulation that is going to change. Whatever way you think about the unknown, there is going to be a significant change in the immigration policy in this country. And that is going to have a jolt in this labor market. Does that, you think, show up in 2025? Or is that a 2026 and onward problem, the supply side of this narrative?
Yeah, I think we know that the pace of immigration will slow. There already is some evidence that it has slowed. So that means a slower rate of labor force increase. And so then the question that you're asking is the job growth keeping up with labor force growth? Is it stronger than labor force growth? Is it less strong than labor force growth? If we look at the most recent payrolls readings, we're running a pace over the last 2 months, 140,000 a month. And you'd say 140,000 a month, that sounds fine. But remember, this data is overstated by 70,000 jobs per month. We know that from the benchmark revisions, 818,000 downward revisions over a year, so it's about 70,000 a month. If you make that adjustment, we're only running about 70,000 a month new jobs. So that means even if immigration slows, we don't have a problem with an undersupply of workers. We have a problem with an undersupply of jobs, an undersupply of hiring.
So what kind of a slowdown is that? I mean, everybody else is talking about no landing, so soft landing, no landing. Certainly recession is not a word that anybody's using in regards to this economy. So what kind of an economy and growth rate is that narrative that you're saying in the jobs market?
This is exactly the problem with the narrative right now. More than half of the people in this country think we're in a recession right now.
Yes, and we were just saying that in the break, weren't we?
Yeah, so it's a very different story if you're kind of the median consumer in this economy, or you're a small and medium firm, right? You've been hit by higher labor costs. Your borrowing costs are still high. We talk about easy financial conditions because credit spreads are tight and equity valuations are high. If you don't issue equity, if you don't issue corporate bonds, which are most of the companies in this country, it doesn't matter for you. So I think it is a very different story if you're kind of in the middle of the economy versus the very higher end of the economy. And I think that is where the market has kind of lost the sense that things could be weaker than they look from the top line numbers.
Yeah, it just depends which part of society you're sitting in, whether you're sitting with a healthy 401k or perhaps in some other part of the economy which has had a real recession.
Exactly.
Andrew, thank you so much for being with us this morning. Let's see what the FOMC delivers and the guidance. That's Andrew Hollenhorst of Citi. Quick snapshot of the real. The dollar is almighty, but let's have a look across the asset board. First of all, you've got stocks up 1/4%. Roll it over. I want to get straight to the real. This is the much more important concept for us to deal with today. We traded through a record low yesterday at pretty much down 21% on the year. You can see the dollar up again over the past 3 days. There's been massive intervention by the central bank, forceful intervention, and still it has had very, very limited impact. There is the move over the space of a week. Jeffries says this is a rout and it's a train wreck in terms of what's happening within the emerging market in Brazil. We'll keep you abreast of those market moves. Coming up, shutdown showdown. The lawmakers released the government funding bill ahead of Friday's shutdown deadline. We'll discuss that with our Washington reporter in just a moment on Bloomberg. It is Bloomberg Brief. I'm Menace Cranny here in New York. The funding challenge continues on Capitol Hill. House Speaker Mike Johnson struggling to reach a deal to keep the U.S. government open beyond Friday after lawmakers released their short-term bill to avoid the shutdown. Meghan Crane joins me now. Meghan, I mean, this is a real test for Speaker Mike Johnson, isn't it? My favorite line was that they're stumbling into Christmas, literally, with lawmakers decorating the tree with all their pet projects. It's a brilliant line. It sort of encapsulates what is happening on Capitol Hill. What are the stumbling blocks and what are the heaviest gifts they want to hang on that tree?
Good morning. So this is a Christmas tradition in Washington. It certainly has become one to try to fund the government right at the end of the year when everyone is trying to leave town. So the stumbling block here is basically that conservative Republicans on Capitol Hill are not interested in large funding bills. They want government trimmed significantly, and it's very difficult to agree on how to make that happen. So, they have reached a deal to stretch government funding through the end of March, and it will very likely pass with help from Democrats. It's important to remember that that same calculus cost Kevin McCarthy his speakership just a year ago. It feels like forever ago, but it was actually just last year. Trying to fund the government through bipartisan cooperation. This bill includes some disaster funding that the Democrats wanted, and conservative Republicans are not happy about that. They really don't like these continuing resolutions. Interestingly, just about an hour ago or so, Elon Musk tweeted that the bill should not pass. I'm really curious how people are going to react to that on the Hill and whether Donald Trump reacts to that. Like I said, they still have Democratic support, so it will probably pass. But that could. But
then Meghan, this really raises the question about the policy path forward for 2025, doesn't it? Right. I mean, they're going to have a slim, razor-thin majority, and this is where, as Anne-Marie has said several times, and we've talked about it with you, everybody's a kingmaker. So this doesn't bode well for policy execution in 2025 with the Trump mandate the way that it is.
It doesn't, right? I mean, Donald Trump won convincingly, but Republicans did not win convincingly in the House. Until the end of March or even April, they will have a 1-vote margin, which is not much room to, to maneuver with for Speaker Johnson. And, he will have a very difficult path to continue to move things forward, and it will essentially be impossible to do without acting in a bipartisan way.
Indeed. And then we've got the Biden administration on the way out the door. They've been debating what they'll do with Chinese semiconductors and a probe into that for months. Why act now? They've already upped, on legacy semiconductors, they've already upped the tariffs. Why put this probe in place now? Is this one last swan song for the Trump administration to deal with?
That's a good question. I think I'm not sure it's just handing it off to the Trump administration. I suppose it just maybe was time to do it. But it is interesting that now it will land on Trump, right? This investigation into chips will become Trump's. It will give Trump ammunition to sort of impose more tariffs on China, trade restrictions on China. And I think that'll just be really interesting to watch how that manifests, whether they sort of go along with the national security concerns about chips that the Biden administration has shown.
And let's just round off. We have the appointee for Ukraine for Donald Trump, president-elect. It's Keith Kellogg. Now, we understand he's going to be going to Kyiv, but there is a line in this reportage that he may be open to a visit to Moscow. That's going to be fascinating given the amount of sanctions that we have at the moment. So why do you think they're flying this kite about his potential to go to Moscow? What does it say about an expedited foreign policy resolution?
Right. So Donald Trump has been very clear that he wants an end to the war in Ukraine to come very quickly, and that he's willing to really push Ukraine to make concessions to make that happen. And this is just another sign of that they are willing to make pretty bold moves to end that conflict in Ukraine, even if it means benefits to Moscow in the end.
Okay, Megan, thank you so much for being with us this morning. That's Megan Crane in Washington on the latest political stories. As we broke at the start of the show, U.S. graphite producers here in the United States, they're looking for sharp tariffs on Chinese graphite, arguing that the subsidies from Beijing make it impossible for them to compete. Now, a sharp tariff increase would raise the cost of US-made EVs, threatening to raise the prices of the cars, which have already seen their subsidies at risk of being removed. President-elect Donald Trump certainly has intimated that, along with Elon Musk. What does it mean for Tesla, of course? Let's stay with the auto story, because across to Japan, we've got stocks in Nissan surging the most in 5 decades. Bloomberg has learned that the automaker has become the latest buyout target. Nissan's biggest shareholder, Renault, is seeing its shares rise after saying it would be open to the two companies pursuing merger talks. Let's get to Albertina Torsoli. She joins me now. Albertina, Honda and Nissan getting together. It's a big political gamble for Japan, and it's certainly Nissan does not have a strong hand in this negotiation. Putting the two of them together, what would we get?
I think that certainly Japan has a problem, having some weak players, a player that used to be very big like Nissan, it's a big problem. So I think that the problem they have at hand is trying to figure out how to have come up with an idea, a big player that can take on Toyota, but also other car makers in the world that are moving. Yeah. Of course, you have Chinese EV manufacturers, you have American players, you have a lot of movement right now, and you have a lot of challenges. And Nissan tried to, was keen on rebalancing the alliance with Renault, didn't want to be controlled by Renault. Has its freedom back in many ways because, Renault is sending down those shares. The rebalancing deal will end up with a 15% stake only in Renault's hands. But of course, that freedom also comes with challenges and risks, right? And Renault is not willing to pay up for Nissan's problem anymore now that, the alliance has been partially unwound.
Yeah, well, Nissan's bleeding cash. It's got a $1.6 billion maturity wall next year. They need this deal. You talked about Renault there. Bid this morning, the sense is that this is a relief moment for Renault. As you say, they've been bailing out sort of in a whole variety of ways what's been happening at Nissan. It's a fairly tortured relationship between them, isn't it?
For sure. Yes, it's been tortured over the years. I think it's a bit too soon to talk about relief. I just think Renault is eager for Nissan to find ways to become stronger. And, when you own, to date, Renault still owns 36%. Part of it is in a trust, so kind of indirect, but part of it is still direct. If Nissan becoming stronger will go through a deal, a merger, a new partnership, well, why not, right? So I think that today the main point is that, yes, Renault as main shareholder will have to give a nod to anything that Nissan decides. If it wants to pursue one deal or another deal, Renault will have to say yes, because it has a say on the matter. And they will have to see whatever deals or possible projects come up their way, and they will have a look and they will protect their interests. But of course, I think once again, the main point in making sure that Nissan, solves its issues, whatever way it is. The issues are big here. In early November, Nissan announced, slashed the profit forecast, said it would have to eliminate 9,000 jobs globally, announced a 20% global cut to global output. I mean, all of this will reflect also in Renault's numbers, right? If Nissan doesn't solve the problem. So I think that the framework of the new alliance between Renault, Nissan, and Mitsubishi is to support each other. And Renault will probably support Nissan if it finds a go way out of the crisis. I think that is very factually what we can say today.
Where do you think Honhai could fit into this? I mean, we understand that they have made an approach. Obviously you've got national champion interest at home in Japan, and then you have this other potential approach. Where does Honhai fit into this?
I think that a lot of parties must be looking at Nissan and seeing what's in for them. Can they play a part? Once again, how M&A is, or how movements are. If there's a company perceived as weaker, then people start looking. And especially since talks with Honda and Nissan didn't start yesterday, they have been going on for quite a few months in different shape or form. Others are looking, and others may be coming forward. Now is the time to move, right? Not when a Honda-Nissan deal is done, if a deal comes. So I think that it will be a period of turmoil for Nissan, a period of observation for Renault, and whoever wants to play their hand probably wants to do it sooner rather than later, because the Japanese government will try to find a solution as quickly as possible.
Albertina, thank you very much. Great upsum. Albertina Torsoli there on the Nissan potential deal. Here's a look at the day ahead for you. U.S. housing starts and building permits 8:30 a.m. But the main event of the day, it is the Fed announcing their rate decision at 2 p.m., followed by the Chair Powell's press conference. What will his tone, what will his intonation be? Micron reports their earnings after the market close. We'll run you through those in the morning. A couple of stocks to watch. Micron rising ahead of its earnings. The street to focus on the AI demand side of the equation. Nvidia rising after entering that correction territory, snapping 4 days of declines. And then Citizens Financial raised to a strong buy by Raymond James. Obviously, we're keeping an eye on Tesla and Boeing as well.